Double Bollinger Bands, Definition and Construction. Earlier, we learned a bit about standard Bollinger Bands, hence BBS for short, as support resistance indicators. The key point was that they are useful support and resistance indicators only in flat or gently trending markets, but not during strong trends. Double Bollinger Bands, hence DBBS for short, are a powerful variation on the standard single version because they tell us much more about momentum and hence trend strength, both in flat and strongly trending markets. In fact, unlike standard BBS, they are exceptionally useful in strongly trending markets because they help us to better understand when a pair is in a trend or a trading range, whether a strong trend is likely to continue, low-risk entry and exit points. As the name suggests, DBBS consists of two sets of BBS. A set of BBS at the usual two standard deviation distance above and below the 20-period simple moving average line in the middle. A second set of BBS plotted just one standard deviation above and below that central moving average. These are just the usual default settings. Traders can and do tinker with the type and duration of the moving average and the number of standard deviations. Here is how to plot DBBS. Creating DBBS is easy. First, plot a standard set of BBS. Using a typical charting package, that means going to your menu of technical indicators and just selecting Bollinger Bands, along with the standard 2-20 settings, which stand for two standard deviations and a 20-period simple moving average. Then repeat the process by again selecting Bollinger Bands from your list of available indicators. But this time, change the settings from two standard deviations to one standard deviation. That's it. You may want to change the color of one of these sets of BBS as well as the color of your central 20-period moving average so that they're easier to see among the other indicators that you may have in your chart. Here's an illustration. Here's the same gold chart we saw in the last lesson. Here's that same chart with DBBS plotted on it. Here's a brief explanation of each line. A1, the upper BB line that is two standard deviations away from line C, which is the 20-period simple moving average, SMA. B1, the upper BB line that is at a one standard deviation distance from the 20-period SMA. C, the 20-period simple moving average, SMA. Figure 8.2 is a weekly chart, so this is a 20-week SMA. Again, this is both the center of the DBBs and baseline for determining the location of the other bands. B2, the lower BB line that is one standard deviation from the 20-period SMA. A2, the lower BB line that is two standard deviations from the 20-period SMA. These bands mark three separate zones. These zones provide the added information about the strength of a trend. In other words, even if there is no other support and resistance to serve as a reference point, as was the case with gold until late 2011, when price enters one of these zones, we have a better idea of whether price is likely to continue its trend, halt its trend and stay within a horizontal trading range, or reverse direction. We'll look more closely at these three zones and their meaning in the next article.